The global economy functions smoothly thanks to a common financial language, the US dollar in the current system, that prevents the daily renegotiation of millions of transactions. The dominance of the dollar as the world's reserve and settlement currency is not merely a symbol of power, it is a practical infrastructure that lowers transaction costs, facilitates hedging, and reduces friction in global trade. Data from the IMF and BIS show that this dominance is reinforced by network effects and deep financial markets. Historical experiences, especially the collapse of the gold standard during the interwar period, demonstrate that when a common financial language disappears, trade does not stop, but it becomes more conditional, political, and costly. Today, the transition from a single monetary system to a multipolar and competitive structure, fragmentation, is also bringing significant costs. The effects of fragmentation in the monetary system. The division of the global monetary system creates profound changes in three major areas, ranging from macroeconomics to everyday life: financial friction and risk. Exchange rate risk increases for companies and banks. As hedging costs rise, vulnerabilities stemming from borrowing in different currencies and the risks of maturity/currency mismatches begin to emerge. Strategic state finance. Central banks are forced to manage more volatile reserve portfolios, establish bilateral payment agreements, and make explicit choices between geopolitical blocs. Diversity does not bring simplicity, instead, it increases political pressure. Instability in daily life. Price volatility in imported food, fuel, and medicine intensifies. Inflation becomes more irregular, while mortgages, savings, and loans become vulnerable to currency shocks. The countries and citizens most affected are low-income economies heavily dependent on imports. Winners and losers. In this process, major regional powers may gain greater monetary autonomy, sanctioned states may discover alternative routes, and countries with deep local bond markets may soften the impact of shocks. However, for small, indebted, and import-dependent economies, this transformation represents an expensive dependency with no real escape route. In summary, according to IMF and ECB data, the dollar still maintains its leadership today, yet the search for alternatives and the trend toward bloc formation are growing. Moving away from a single global monetary system will not create a fairer order, on the contrary, it will make finance more regionalized, trade more conditional, and everyday life more expensive. Living in a fragmented financial world is not impossible, it is simply far more difficult.